Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And with the Fed on a path to continue to reduce interest rates so that the economy doesn't fall into a recession, there is a problem for traders and investors seeking cash income from their investments because the interest rates earned from bonds and short-term money market funds is just not going to cut it anymore. And the good news is that there is an easy solution to this problem using a very easy to understand option strategy that we're going to be teaching you in this video. We're going to show you how you can earn $1,000 a month or more in cash income from your portfolio by combining the naturally modest level of dividend income that you can earn by owning shares of stock with an easy to learn option strategy that can get you to your monthly cash income goals much more quickly than you'd think. Now, before we get into the option strategy that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. To illustrate how this works, let's pull up a chart of UPS, United Parcel Service, the well-known package delivery company with the brown trucks driving around all over the place. And as you can see, UPS closed at 130.58 on August 1st of this year, just a few months back. And as you can see, UPS has been selling off all year, and this technique we're going to be showing you actually performs best with stocks that have sold off to some extent but are considered long-term solid investments. So UPS would be a good candidate for the technique we're going to be sharing with you in this video. Now, something important to understand about UPS is that while it's not what the financial markets refer to as a dividend aristocrat, which is a stock that has raised its dividend for at least 25 straight years, it's actually raised its dividend for the past 22 years in a row. So it's actually getting close to that stature. And prior to August 1st, the most recent dividend, which was issued on May 10th, was $1.63 per share. So let's say that our goal was to earn $1,000 a month in cash income. And let's say that on August 1st of this year, we owned 700 shares of UPS, which, as you can see, would have been worth $92,712 at the close that day. Now think about it. If you own 700 shares of UPS, then when that dividend of $1.63 per share is paid, you'll collect $1,141, which comes out roughly to $380 per month. So then how are we going to get to $1,000 a month in cash from our UPS investment if we have a 620 shortfall every month? Well, let's take a look at how this can be done. So let's pull up an options chain that expires about a month later from August 1st, which is the August 30th, 2024 options chain for UPS. And let's say that we look for a call option as high as possible up on the options chain with a price of at least 90 cents. Well, in this case, that would be the 136 call priced at 95 cents. And so let's go ahead and sell 7 of those. When we do that, owning shares of stock and then selling one call for each 100 shares that we own, when we do that, which is what we've done here because we've sold 7 calls against our 700 shares, so one call for each 100 shares, when we do that, we are entering into what options traders refer to as a covered call position. Now, you might be wondering why we insisted that the price was at least 90 cents. And so to answer that, let's take a look at the cash flow from selling those calls. And as you can see, we received that price of 95 cents. But remember, each options contract relates to 100 shares of stock. And so we multiply that price by 100 and we sold 7 of them. So when you multiply it all together, we end up with $665 in cash for the August 30th trade. And remember, we had a shortfall of $620 on a monthly basis to get to our goal of $1,000 because the dividend amount only provided us with $380 per month. And so now you can understand why we insisted on at least 90 cents for the call we selected, because much lower than that and we would not meet our monthly income goal. Let's move to the day that this option expired, August 30th. And as you can see, the stock itself closed at 128.55 that day. Well, remember, we sold those 136 calls, which means that on the day these options expire, the stock closed below the call strike price, meaning that the call we sold expired with no value, because there's obviously no value to the right to buy 100 shares of a stock at a price much higher than is trading in the open market. And therefore, those options have zero value and they expire worthless, meaning we just pocket the initial cash flow of $665 as our trade profit. And so to track our income on this initiative, we're going to create this exhibit, which shows that our first cash flow event is pocketing that cash from the first covered calls that we sold. And then the next event you almost could have forgotten about, that is the payment of the UPS dividend itself, which happened on August 19th. And since that dividend represents 3 months of dividend income, if you think about it, because dividends are issued quarterly, we can see that that's a pretty large number, a dividend of $1,141 arising out of 700 shares of stock that we own, as you can see from the calculation. So now the way we're going to continue to create this extra income to supplement our dividend income is that we're going to be doing this every month. And so the next options chain, about a month away, is actually the October 4th options chain, which expires in 35 days. And so we go ahead and find an option, which again is worth at least 90 cents, yet it is as far above the current price as we can get. And as it turns out, that is again the 136 call option, which is priced this time at 92 cents. So that meets our criteria, and so we go ahead and sell 7 of those, which produces, in this case, $644 in cash, as you can see. And when we now move forward to October 4th, you can see that UPS has rallied slightly since we sold that new set of 136 calls, and it closed at 131.25 on that date. But 131.25 is still well below the 136 strike price of the calls, and so again, results in our simply pocketing the $644 in cash that we collected initially. So we'll add that win to our scorecard of cash events, and then we're going to move to the next options chain that expires in about 30 more days, which is the November 1st options chain. And in this case, the 145 calls are the ones that yield at least 90 cents, as far above the market as we can. And in this case, the call options located at that strike are priced at $1.12, which translates into $784 in positive cash flow for us. And so when we move to November 1, we can see that UPS experienced a mild rally again, closing a bit higher at 134.05, again, well below the 145 strike price where those 7 calls were located, resulting in our again pocketing that $784 as our profit, which we'll go ahead and add to our scorecard. And so when you look at all 3 months, you can see that we collected, between the monthly covered call premiums and the dividend itself, a total of $3,234, which resulted in an average of $1,078 per month, slightly exceeding our cash flow goals for our UPS shares. Now, before we wrap up, I wanted to point out a couple of tips for trading strategies like this to meet your monthly cash goals. First off, you'll notice that we tried to place our covered calls well above the price of the UPS shares we owned, and you might be wondering why. And that's because we need those shares to trade covered calls, because your broker needs to know that you've got the shares to deliver to the call buyer who you sold those calls to, should he wish to buy them at the strike price of those calls, which is his right as soon as he buys those calls. And so if the stock's price closes above the strike price of the calls on expiration day, the owner will exercise those calls, resulting in your shares being sold at that strike price, meaning that you'll need to rebuy those shares at possibly a much higher price to continue your campaign of selling covered calls, which means you'll miss out on some appreciation of those shares. So make sure to sell calls as far as you can above the stock strike price while still attaining your cash flow goals, if at all possible. Secondly, this is a bullish strategy, meaning that if you're not bullish or at least neutral about the stock, you shouldn't own that stock at all, frankly, in my opinion, and you certainly shouldn't be selling covered calls against it. Why? Because the biggest risk of this strategy is that the stock goes down a lot. Why? Because if the stock goes down while your calls will no doubt expire worthless, the depreciation of the value of your shares will normally be much greater than the profit you're going to make from selling the calls and bringing in that cash. And furthermore, if the stock drops too much to get your cash income each month, you'll be forced to sell covered calls at a price that might actually be below where you bought the shares, which means that if the stock closes above the call strike price, you could end up being forced to sell your shares below your initial acquisition cost, which effectively locks in a realized loss on the shares. And you obviously don't want to do that. You want to avoid that. So you want to sell your covered calls at a price no less than your initial cost basis, and hopefully well above where it's trading each time you open up a new covered call. And so what I'd like you to take away from today's video is that you are not limited to the dividend income that you receive from your investments to generate cash flow for you. Through intelligently applying the covered call strategy, you could substantially increase your income from your dividend-paying stocks, which will allow you to meet your monthly cash flow goals. So as you see interest rates continue to drop, you'll have an answer for that problem, a wisely designed covered call program on solid stocks that you believe in.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.